Okay, so SMSF property and the new tax rules. Thank you to the federal budget last week. We're just going to go through what its impact on the current landscape is, how that stacks up for investors, the implications of the Division 296 tax rules, what are the boundaries that we need to stay within, and what's a map moving forward, and a quick Q&A. So without further ado, let's get started.
Mm-hmm.
So broadly speaking, superannuation is unchanged by the budget, essentially. So it's still a means by which people who want to choose to invest in property using their superannuation investments can do so in a tax effective manner. So the implications of that are, after the budget, capital gains on property are now very much going to be in line with marginal tax rates for salaried income earners. In superannuation, however, after you've held an asset for 12 months or more, that tax rate, that effective tax rate, falls to 10%. It's actually 2/3 of the 15% tax bracket as explained in the Act, but 10% is what it effectively comes down to. Tax on earnings within superannuation is at 15%, but that said, if you get a bare trust inside a super fund, the expenses of the bare trust offset other earnings within the fund.
So it's based on net income.
That's right, but you can use if your property is making a loss, which most in super don't, but if it does, you can use that to offset income in other areas, which you can't do anymore outside of super. So negative gearing changes. There has been no negative gearing changes inside of SMSF. SMSFs are excluded from the new negatively gearing chart, the new changes essentially.
Mm-hmm.
Tristan, can we just go to the next slide? Okay, so what do we need to kick a fund off? So broadly speaking, ASIC advises that an investor looking to start a self-managed fund needs 250 grand or more. That's been a number that ASIC has advised as a safe level, as a starting point for many years. And it's broadly in relation to what are the operating costs after setup of having your investment in a self-managed superannuation fund. So as you can see there, annual accounting and auditing, it's roughly $2,500 to $4,500 a year, depending on what's in the fund.
Mm-hmm.
If we use, say, Australian Super as an example, their administration and fund management costs in there are 1% or more, depending on your investments. So if you had 250 grand in Australian Super, that's about 1%. That's about what it's going to cost you in an SMSF. Where self-managed super becomes an advantage is where, if you have hypothetically 500,000 in the same assets in the fund, as opposed to an expanded number of assets, it's still only costing your accountant $2.5 grand to do the financials, the tax, and the audit. So your administration costs halve in comparison to industry funds and retail master trusts, where your administration costs and investment management costs are a percentage of your balance, as opposed to an amount charged based on the job. So that's where ASIC comes from on that number of what's required to make it worthwhile setting up an SMSF.
Mm-hmm.
If we then take, for an example,
in fairness, Matt, could I say, Matt, if the thing that ASIC would not actually intervene to stop somebody if they had a lower balance than that, but they so if someone had
the members, it's up to the members to make a decision on opening a self-managed super fund. But it's up to industry participants like myself to make sure that those members are aware that that's ASIC's advice, and that they should, really go to the Money Smart website and be across the intricacies of having a self-managed super fund. And they should also be going to the ATO website to look at their responsibilities as members and trustees.
Mhm.
But if after gaining that information, they choose to open a super fund with 100,000 or 10,000, that's a matter for them. It's self-managed.
So like
choose to do
or
that.
any government body wouldn't stop them from buying a property, for example. It would only be that they had sufficient funds to complete it and they could get a loan from the lender sufficient to complete a property.
The ATO is the regulator of self-managed super, not APRA or ASIC.
Mhm.
APRA and ASIC are there to administer the financial services regime.
Mhm.
So from the ATO's perspective, as long as the fund is operating in accordance with the SIS Act, then they're happy with it.
Yeah.
The rest of it comes down to whether or not they can afford a suitable investment with amounts of money less than 250. Actually, it comes to, can they buy an investment that can they undertake an investment strategy that they're comfortable with, or is their goal with the funds, the money in the fund?
Yep.
The other important aspect of this too, particularly in respect of property, is many lenders now require a cash balance to be left in the fund. Now, many of them are 10 to 15%. Some of them, like Granite, have got a minimum cash balance after the purchase has been made that they require to be left in the fund. So Granite's 120 grand. Some are 10 to 15% of the total balance. And so that's going to have implications on the amount of the loan and what the LVR is that lender is supplying, is requiring the fund to retain. Tristan, could we have the next slide, please?
Would 120K be like about the highest, would you say?
Sorry?
Would 120K being left after the property is settled, would you say that's
Look,
like
lending provisions around self-managed super funds are fluid. And that's why we recommend that anyone that's wanting to start an SMSF for the purpose of buying property is that they engage us to conduct a feasibility study at the outset. If they have a preference for a particular lender or broker, we work with that lender or broker to see what their requirements are at that time. It's very dangerous to assume that they're just static because they change all the time. So we do a feasibility study, go back to the client's broker and go, right, we've got 400 grand, 300 grand, 100 grand in the fund. This is the strategy they want to take. What can they achieve with the resources they have available within that fund? And then we come back, obviously, to the prospective members at that stage. Nothing's been done, and say, look, with the resources you've got, this is what you can do. Does that fit your strategy or not?
Yep.
So what actually is the situation at the moment is amounts of money that are in accumulation in superannuation. Actually, I'll start with pension. Amounts of money that are in superannuation in pension phase up to the pension limits of 1.95 are tax-free. Amounts of money from under $3 million in accumulation is 15%, above 3 mil is 30%, and above 10 mil is 40% tax rate. So that's a tax rates in super. So logically, if we're investing in super in property and our motivation is do it in a more tax effective manner than in our own names, if we're looking at an investment above $3 million, clearly we need to give some consideration toward whether or not the effective tax rate on the whole investment is still worthwhile. That said, an investment of that magnitude, it would also be a matter of whether or not there was enough money in the fund as well. Kristen, can we have the next slide, please? Righto. So the property can only be used for retirement. So there's a famous act, well, to people that are interested in super, there is a famous act going back into the late 80s, early 90s, called famous case, called the Swiss Chalet case. So in the early days of superannuation, there was a group of Macquarie Street specialists in Sydney who piled a whole pile of money, claimed tax deductions on it, and bought chalets in France. Now, the commissioner didn't like that, argued that it failed the sole purpose test of superannuation, and it went to court. Consequently, those professionals won the case against the commissioner, and in response, the Commissioner of Taxation changed the Act to explicitly exclude residential property from being able to be utilised for any personal purpose whatsoever, including that use by any associate, employee, or family member. And it's important to note that that applies only to residential property, not commercial property. Commercial property can still be used by yourself. You can rent it from your own fund. You can sell it to your own fund and buy it back from your own fund. You cannot do any of those things with residential property. So that's an important distinction to understand. So what you can't do, hence the French Chalet case, you certainly can't buy a holiday home with funds in your super fund, and you most certainly can't live in it. You can't rent it to family members, and you can't buy it from yourself. What you can do is just buy residential property through a real estate agent or auction that's from a third party that's unrelated to yourself. As I said, those restrictions relate only to residential property. Commercial property does not carry those restrictions. It just needs to be conducted at an arm's length basis and on commercial terms. You can, in fact, buy your own business premises from yourself. So this is one of my favorite strategies in super, actually. If you're a mechanic or have some other kind of business that requires an industrial unit or shed, your super fund can buy your premises for you. You can borrow money within it as a bare trust. You can do it via an ungeared unit trust. You rent that property then off your super, and that then allows you to get additional funds in your superannuation from your own efforts. So it's a pretty good outcome. The rent to your super fund from you represents a tax deduction to the business renting the premises. So it's very effective from a tax perspective. Tristan, can we have the next slide, please? Okay, so step one is never what property we're going to buy. Step one is always the strategy, the feasibility. You just need a couple of pay slips and your last statement from your super fund so we can do an actual feasibility on your resources to determine exactly what you can attain through getting a loan through super or in using a unit trust strategy, so we know exactly where we stand. After we've done that initial feasibility, that's where we start to set the strategy. But the next step is always a setup. We go out, we set up the fund, the bare trust, the trustee. We talk to the mortgage broker, the lawyers that are conducting the conveyancing. We get the forms together to do the rollovers from the fund, from where the funds are presently. And we get all of that in place. At that point is where buyers agents go out, start seeking a property to meet the strategy of the investor. Whilst all of that is occurring, then we're going out, we're engaging our SMSF specialist broker to secure the finance. We're dealing with them directly and updating them as soon as we get the information, such as fund regulation with the ATO, tax file numbers, ABNs, bank account details, where the rollovers are up to, etc. Now your property search with a confirmed budget and structure and the ability to move quickly and confidently, go find the right property, you have money in your fund, you can make deposits and proceed with the purchase and do so in an efficient and fast manner. Tristan? Thanks, mate. So just some of the questions are, will Division 296 affect you? That's certainly something that we address in the feasibility study. Superannuation, for all intents and purposes, is a legal tax haven. The only difference between buying a house in your name or a super fund is that your super fund has a substantially lower marginal tax rate than you do. If it doesn't, don't use it. And Division 296 obviously only impacts a balances over $3 million. It is important, though, if that is where you will be at once you purchase a property, we do need to do an assessment on the tax effectiveness of that investment in super. You can use your industry or retail super fund to roll into a self-managed fund, but you cannot use it to buy property. Those fund structures are set up solely to invest in large liquid assets like shares and managed funds. I'm yet to see one that offers the ability to buy direct property for a single member. As a couple, you can combine your super balances in superannuation. So if you've got a couple and they've got 200,000 each, they can both roll into a super fund and have 400,000 in that fund. That fund can invest that money as a pooled amount of money, but those members will still be reported to as having separate balances by the fund. That's part of the financials and audit process of the fund each year. So how long does it take? Ideally, you want to budget for 4 to 6 weeks to settlement. Sometimes it can take a lot longer, and that can be a problem, but usually we'll know that in the first week or so of making applications for rollovers and regulation of funds, etc. Often new residents that have recently gained citizenship, their funds can take longer to become regulated because names need to be checked and whatnot. That's just a function of the ATO. But usually you're looking at settlement in a 4 to 6 week period. And just like to end on this, as we always do, please don't proceed until a feasibility call has been conducted with us. We will find out what your resources are and what you can do at the start before anyone commits any capital or efforts to it. That way you know exactly what you can achieve with the resources you have. Okay, that's all I've got to say. Any questions? Brandon, turn your microphone on.
That's good advice. Thanks.
That's okay, mate. Anytime.
It's about time someone shut me up. What's the tax rate that does apply above the 3 million in super?
30%.
Is that on capital gains, earnings?
Everything.
Everything's 30%.
Yeah, it's just flat 30%.
When did that start?
Last year.
Okay.
I don't recall the exact date, but it was last year after the last budget.
Okay.
Okay. Any other questions?
No.
No.
Can you explain Division 296 in more detail, please?
Well, 296
Yeah.
is a tax leveled on superannuation account balances above $3 million. So where you have an account balance for a single member, this is not the members combined, this is each. So a couple would need above $6 million between them in super for this to apply. Or you would need to have one member have a substantially higher balance than the other. So as an individual, if your account balance is above $3 million, essentially any income earned on those assets that's deemed to be above that $3 million threshold is taxed at 30%, and the same with the capital gains.
But it's only on what's above 3 million.
That's right. But additionally, you can't get cute with what assets you allocate there to minimize the income or capital gain either.
Okay. That's up to the ATO.
No, it's just got to be reported on a pooled basis.
Right.
And that's where the power of some funds that hold hypothetically property assets in unit trusts for members above 60 that are fully retired, they can pay out to themselves an in-specie transfer of those units as a pension to reduce their account balances. That's an effective means by which to reduce the asset of the fund if it's a property without having to liquidate the property to get under the threshold. And we've done that for a couple of clients.
So it's creating a unit trust to then.
Well, no, the unit trust would have to be in place. It's a specific situation. You won't come across that very often.
Okay.
But it's a consideration for people that have particularly large balances that perhaps instead of a bare trust strategy of borrowing funds within super, they may be better off using cash from their fund to invest in an ungeared related unit trust and freeing up capital from other assets to put into that trust as well. And the trust purchases the property investment with cash, not debt. And that way, that unit trust can effectively be dialed up or dialed down within the super fund. But you would only, that's a strategy of managing staying under the Division 296 asset threshold.
But then does the ungeared unit trust contribute to that total amount that is pooled for taxation?
No, it's the ungeared unit trust doesn't magnify the value of the property. All it does is give you the ability to distribute some of the property out of the fund in pension payments, as opposed to if it's a single asset, such as in a bare trust, to reduce the assets of the fund, you would have to actually sell the house.
Yeah. Sorry, does the ungeared unit trust contribute to that pool for the $3 million calculation?
Only the units that are held by the fund.
And you work it out pro rata percentage.
Yeah.
Okay. Okay. Yeah, then you could allocate a larger amount by buying units in the personal name.
That's right. You buy it in your own name. You could make it as an in-specie transfer to yourself, potentially gift those units once outside the fund to children or grandchildren or someone else. Just depends on the circumstance.
Yeah, right. You can actually gift units without them being paid for.
Well, if you're a state, sorry?
You're able to gift units without them being paid
outside the fund, not inside. So they've got to come out to the member as a pension payment. What they do with them once they're in their hands is a matter for them.
Okay. In their hands personally, then they can gift them.
Yeah, but once it's in their hands, like say in a given year, we get a valuation done on the property. The fund is in 100% pension phase. Those units get gifted out to the member at that valuation of the property. The capital gain on the distribution zero because the fund's in pension phase. So in the investor's hands, in the member's hands, the units are valued at exactly what the property's worth today. Those units can be transferred to someone else. It's not a capital gains issue because it's just a one-for-one transfer.
Okay.
And, you think about it. If you're a member of a fund and you're 90 years old and your estate plan is for that property to go to one or more of your beneficiaries of your estate, you may well choose, instead of selling it down, to distribute the units out prior to your death to those beneficiaries.
Yeah.
Where you can lock in a new floor for capital gains in their hands.
What do you mean floor for capital gains?
So let's say you bought a property 20 years ago and put into super in a unit trust.
Yep.
Okay. And you paid $1 million for it 20 years ago and it's worth whatever it's worth today. Call it $2 million.
Yep.
So you start a pension in your super fund and that's the asset.
The whole asset?
Yeah. There's a unit trust, and 100% of the units in the unit trust are owned by the super fund, and that asset is the underlying asset in that unit trust.
Yep.
Yep. You turn 90, you decide that I'm distributing it out to my kids. So you transfer those units from the fund to yourself as an in-specie pension payment.
Mhm.
Those units are valued at that property being worth $2 million, which is its valuation today, not the $1 million you paid for it initially.
Yep.
So the receivers of those units, their cost base on that asset is $2 million.
Yep.
So they've got no capital gains tax liability on day one.
I see what you're saying.
If they retain those units for another
regardless
10
of when they sell that, there'll be no CGT.
Well, if they keep it for 10 years and the value of the property goes up, there's going to be CGT on that.
Oh, but not on what they bought it for.
Correct.
I see. Okay. But then
Resets the capital gains tax clock to the day they receive it without
right.
any tax implications, because it came out of the fund where the CGT event occurred.
Yeah.
In a tax-free environment because of the pension.
Yeah. But then in that example, then they would be liable for the CGT of what it grew in the time they held it, because they're holding it
like
personally.
any other asset.
Then they're holding it personally themselves, right?
Yeah.
Yeah. Okay. All right. Just understanding it. Cool.
Sure.
And what does in specie mean?
When you pay a pension, you can do it in two ways. You can pay it in cash. So it's a transfer of cash from the super fund to your bank account, and it's your pension payment. Or it can be in specie. So hypothetically, it could be units in a unit trust. It could be shares in a company. It could be bottles of wine, potentially, if that's the assets of the fund. So you can move the assets from the fund to your personal name as a pension payment, as an in-specie transfer. So you don't sell the asset, you physically transfer the ownership of the asset from the fund to yourself.
Right. So moving the assets rather than cash.
Correct.
Okay.
There's limits on that, but it can be done.